This infographic provides a high-level walkthrough of intercompany reconciliation, a vital accounting process used by large corporations to ensure their internal financial records are accurate before they go public or get filed. The goal: accuracy and reliability. The top left box sets the stage. When a parent company has multiple subsidiaries, they often buy and sell from each other. The primary goal here is to eliminate duplicate or mismatched entries. If subsidiary A says they owe $1 million to subsidiary B, but subsidiary B says they are owed $1.1 million, that's a problem. This process fixes that. Hammer and wrench the 6-step workflow. Step 1. Data consolidation. The process starts by pulling data from various sources, databases and files, and organizing it by entity, example, Subsidiary 1 and Subsidiary 2. Step 2. Transaction matching. This is the detective work. Systems compare the ledgers of different entities to find matches. Matches are cleared. Mismatches, shown in red, are flagged for correction to ensure the books zero out correctly against each other. Step 3. Variance analysis. Accountants look at the why behind the mismatches. Using charts and comparison tools, they analyze differences in currency exchange rates, timing issues, or human error to understand the variances. Step 4. Journal entry posting. Once the differences are understood, official vouchers or adjusting journal entries are created. This updates the general ledger, GL, so the internal debits and credits finally align. Step 5. Financial reporting. The corrected data flows into the big reports, balance sheets and income statements. These are then aggregated into parent GLs and regional reports. The image shows a verified stamp, signifying that the intercompany noise has been removed. Step 6. Confirmation and reliability. The final step is the seal of approval. The results are compiled into a final statement, signed off, and confirmed as reliable for stakeholders or auditors. Part 1. Why do differences occur? The root causes. Before you can fix the books, you have to understand why they're broken. The left side of the graphic highlights the two biggest headaches for accountants. Timing mismatches. This is a classic cross-border issue. One office records a sale on 1st May, but the receiving office doesn't log it until 10th May. For that 9-day window, the books are out of balance. System and human factors. This is the messy side. It happens when subsidiaries use different software that doesn't talk to each other, silos, have no clear shared policies, or simply lose track of paperwork. The result: a discrepancy, symbolized by the unbalanced scales and the question mark. Hammer and wrench. Part 2. The modern workflow, the solutions. The right side of the graphic shows how modern finance teams move from unbalanced to audit-ready through 3 strategic pillars. 1. Standardized policies, addressing human factors. The fix: get everyone on the same page. You need unified accounting rules across all entities and a dedicated team to manage the communication hub. No more guessing how to log a transaction. 2. Integrated systems, addressing system factors. The fix: use APIs and cloud software to create a single source of truth, SOT. When systems sync in real time, you eliminate the manual data entry that leads to errors. 3. Proactive reconciliation, addressing timing. The fix: don't wait until the end of the month. By using automated near real-time matching and strict cutoff periods, disputes are resolved as they happen, not weeks later. The big picture: strong, reliable reporting. The graphic concludes that by moving through these steps, the unbalanced scales become perfectly balanced. The ultimate takeaways for your viewers: trust. High-quality data builds trust between entities. Efficiency. Faster dispute resolution means a faster month-end close. Audit-ready. You aren't just guessing. You have a verifiable trail for the auditors. Scales the concept. Netting to 0. The top section highlights a fundamental accounting rule. In a perfect world, internal debits and credits should net out to 0. If Company A owes Company B $500, then Company B must show an asset of $500. When you look at the organization as a whole, that money hasn't left the family. It just moved seats. This graphic shows that the balancing act is what provides a clear picture of financial health. Building construction, the pivot point, resolve and audit. The center of this image features a teeter-totter or scale mechanism. This represents the shift from identifying problems to implementing solutions. The left side, the challenge, identifying discrepancies. Think of this as the work phase. Cross-ledger data pull, gathering information from different bank accounts and entities. Mismatch analysis, highlighting where the numbers don't add up, marked by the red X. Issue investigation, digging into the data to find the why. The right side, the solution, achieving balance. This is the result phase. Journal entries, correcting the errors found during investigation. Final posting, formally entering those corrections into the general ledger. Consolidated reporting, the final step where all accounts are balanced and verified, marked by the green checkmark. Checkered flag, the final result, audit readiness. The bottom banner ties it all together. The end goal isn't just balanced numbers, it's reliable, audit-ready financial statements. When a regulator or auditor looks at the books, they want to see that the company has a repeatable, transparent process for balancing these internal scales. Building construction Part 1. Intercompany transaction types, flows. In a global organization, money doesn't just move in one direction. The infographic breaks this down into 3 specific flows. Downstream, parent to subsidiary, the parent company provides goods, services, or funding to a subsidiary. Upstream, subsidiary to parent, a subsidiary provides goods or services back up to the parent. This often involves transfer pricing, which is how the price is set for these internal sales. Lateral, sister-to-sister transactions happening between two subsidiaries under the same parent. These are sister companies. Because they are on the same level, reconciliation here is key to ensuring the parent's total assets aren't artificially inflated. Gear Part 2. The critical role of accounts payable, AP. The right side of the graphic highlights the AP department hub. This is where the actual bookkeeping happens. It's important to explain the impact on the ledgers. 1. Invoice received. Payables are credited. When an intercompany invoice arrives, the debt increases. In accounting terms, we credit the payables account. Think of this as adding a weight to the what we owe side of the scale. 2. Payment made. Payables are debited. When the cash actually moves from the bank to pay that invoice, the debt decreases. We debit the payables account to clear it. Key takeaway for viewers: if the AP department in subsidiary A doesn't record the payment at the exact same time the AR, accounts receivable, department in subsidiary B records the receipt, you get a mismatch. Direct hit, the final result. Verified financial reports. The bottom of the image reinforces that the goal of managing these flows and AP impacts is to create verifiable financial reports. By tracking whether a transaction is upstream, downstream, or lateral, the company can eliminate these internal trades when they report their final earnings to the public.